Our next guest notices an interesting trend in the markets right now. Let's go off the charts with Chris Verrone of Strategas, a Baird company. He was just ranked the #2 technical analyst on Wall Street in 2022 in the Institutional Investors Research Survey. Chris, congratulations.
Thank you.
What are you taking a look at?
Well, I think what's notable about this market is how different the action is at the surface level relative to what's playing out under the surface. So the index versus the average stock. And what we do here, we start with the S&P, just looking over the course of the last year. What do we know here? We know that every rally attempt has failed at a lower high, right? So let's call it 40.80 is the 200-day on the S&P. About 41.50 is where the downtrend comes into play. We're presently about 300 points below those August highs. Now, if we look at the triple Q chart here as well, again, as we know, very similar story. Every single rally, lower high, lower high, lower high. But what this doesn't show us is actually the improvement that we've seen under the surface. So the percentage of stocks that are actually trading above their 200-day moving average, 56% today, is higher than what we saw when the S&P was 300 index points higher in August, 51%. So under the surface, the average issue is demonstrating leadership versus the top of the market. This is very, very reminiscent to what we saw in the 2001, 2002 bear market. There were points of that bear market where the index would fall, but you'd get something like 60, 70% of issues above the 200-day. It was the average issue outperforming the top of the tape. So when we take a look at the big weights today, isn't it notable, despite a 15% S&P rally, despite nearly 60% of issues above the 200-day, what's not above the 200-day? Not Microsoft, not Tesla, not Apple, not Amazon, not Google. The largest weights are still the technically weakest parts of this market. So if we take a step back and say, what does this mean longer term? I want to show you a very notable comparison. These were the 5 largest weights in the S&P in 1999. We're talking about Cisco, of course, IBM, Nokia, etc. They peaked at about 20% of the index on 12/31/99. Over the next 7 years, their weight would fall to about 5% of the index. It took 7 years to complete that top of the market losing leadership. Today, as we know, the 5 largest, Amazon, Apple, Tesla, Microsoft, Alphabet, peaked at about 25% of the S&P. We think ultimately this is headed down to 15. So if we're losing the largest weights, it's hard for the index to make a lot of progress. I think 41.50 is probably the top end of the range. But the average issue is where you make money. This is very, very similar to that 2001, 2002 bear market. Very important theme here.
Chris, do they trade as a monolith, or are there certain stocks among those top 5, the 5 biggest, that you think will fare the worst?
I think they trade as a monolith, and kind of go one by one here. It's always the best ones that go last. I mean, Apple is the one that really hasn't broken in a big way yet. I do think that'll be a story in 2023. It's still a weak name, but when you look at Tesla, even the last couple of days as the market's rallied sharply, what really hasn't moved? I mean, Tesla's still below the 200 level. The rally in Amazon looks very counter-trend. Microsoft and Google are just back to where they were a couple weeks ago. So when I look at the big weights, I mean, remember, these were 25% of the index. That's too much. That will correct itself over a very long period of time. So don't lose the plot of the movie. We get these counter-trend rallies, some quite big, but the plot of the movie is the large weights continue to surrender leadership. That's a process that will be measured in years, not in months or quarters.
And Chris, so those names you just pointed out were hardware companies, right? So where are we going? So what will be the sectors that can pick up some of that slack? I talk often that energy, which we know is 16% of the S&P at its peak in 2008. Where do you think the average stock is going to be, though, that picks up that weighting?
Well, Tim, I think what people forget is not only was energy 16% of the S&P in 08, how about in 1980 it was 30% of the S&P. So we went from 30% of the S&P in energy in 1980 to 2% in 2020. The long-term mean's about 12. Can energy get to 12% of the S&P? I don't think that's unreasonable at all. What we've been writing and saying is you want to own stocks or sectors or groups that are doing something demonstrably different than the index itself. Let's start very simple. I want names and groups that are already above where they were in August. You get a lot of capital markets there. Look at Morgan Stanley or Goldman Sachs. You certainly get a lot of the industrials. I think Cummins has acted absolutely fantastic here. So I think the issue for a lot of investors it's not the stocks or the groups that people own a lot of, right? Everyone's still, there's so much legacy positioning in the Apples and the Amazons, et cetera. The things that are actually working here, and I think continue to work, leadership and ownership is still too small.
Chris, thank you. Good to see you. Congratulations on II.
Thank
Chris Verrone of Strategas. Guy Adami, the last time it took 7 years, says Chris. You know, you can argue that markets move a lot faster these days, and the unwind could be much swifter. What do you think?
Yeah, I agree with that. I think things do move quicker. I think Chris would agree with that as well. I don't think it's going to take 7 years, but his point is well made that we're losing the leadership and it takes time to get to some equilibrium. And I think we're in the early innings of that. So, you know, I think people are expecting Apple to have this huge bounce. Microsoft, all these stocks are not trading particularly well, and that's part of a pattern. But I would submit it's part of a healthy bottoming pattern that we need to go through. It just takes some time.